So without wasting time, I just want to recap that when we had in our last session, we had understood what the definition is of charitable purpose, and we had then seen the current regime of registration for not-for-profits and the changes that have happened over a period of time, including the latest changes. Then we had gone to some of the other provisions which affect the taxability, and then gone to the chapter number 3, which is the code of taxation for not-for-profits as of now. We had done section number 11, and we had seen the income not included in total income for charitable and religious purposes. What are the conditions there? And in case our 85% application of income is not fulfilled, then what are the options available? We moved on to section 12, and now we begin from, and we had seen that, section 12 is basically the eligibility section. What are the conditions? So we begin the session now, and the session number 2, the actual session is going to follow, where we will see the, provisions relating to TDS and other miscellaneous provisions in the income tax law elsewhere, which are applicable for not-for-profits. So when we are talking about who is eligible for benefits under Section 11, the Section 12A talks about the conditions for eligibility. Okay, and these are the 3 conditions that have been laid down. The first non-negotiable condition is that if you want to get benefit under Section 11, then you must be registered under Section 12AB. Now there is only one regime. Okay, so there is no old regime, new regime in terms of, the first and the second regime of 1023C and 12A, which we had seen last time. From 1/10/2024, there's only one, regime. That's about it, or scheme of registration. That's 12, section 11 and 12. So first is that you need to get yourself registered. The second thing is that you need to get your books of accounts. You need to maintain books of accounts, and you then need to also get them audited by the chartered accountant. Okay, if it's above the threshold liable for income tax, then the accounts have to be maintained. The books have to be maintained, and now there is a mandatory provision relating to maintenance of books of accounts, which we will also see. The third condition is that we need to file our income tax return before the due date applicable for section 139(4)(a), where not-for-profit 12A entities are generally, considered. So these are the 3 conditions. Now the first and the third condition is non-negotiable, but the second condition, which is a specified non-compliance, there are ways of getting the benefit of section 11. So the point related to maintenance of books of accounts and audit, if it is not followed, then there is another system of computation, which is 13, 10, and 11, which we will see. But for us, for all practical purposes, for us to understand that if I want to get the benefit under 11, these are the 3 conditions. Now I move to section 13. Okay, so we have done 11, 12, and the 13th section relates to specified persons. Specified person means a person whose, any income that is applied for that particular specified person can lead to our not being able to get the benefit of section 11. Okay, so first I will let you know what is it, when does section 11 not be applicable. Okay, that's 13(1). Okay, and it says that if you are doing private religious purpose, not for the benefit of public, then though that will not qualify for exemption under section 11. Similarly, any particular charitable religious community or caste, if the charitable purpose is benefiting. Third, which is the most important, any part of the income or property is of a charitable or religious institution is used or applied for the benefit of persons specified in subsection 3. So this is the section which says, if you are giving benefit, can you give benefit? The answer is yes. Can you give reasonable benefit? The answer is yes. Can you give benefit which is unreasonable? The answer is no. If unreasonable benefit is given, which is also defined in this section, then that particular amount of income used for the benefit of those specified persons will not be part of your Section 11 exemption. The next last one is, of course, the if you have not invested in the modes of investment. So we had seen Section 11.5 last time when we had seen that corpus and accumulation need to be invested in specified modes of investment. Now this 11.5 is being expanded under the new income tax bill, as we will see. If a new section was added in 115 BBI in 2023, which said that if you are faltering on C and D, which is benefit to a person or non compliance with 11.5 modes of investment, then the taxation has been fixed as 30%. And for the benefit that you have given, there is a penalty of the amount of income that has been applied for that benefit, which is unreasonable. And then next year, same thing, it is twice. So these are provisions that you need to know. I have mentioned the section numbers, but I'm not repeating them here for you to be able to understand the provision. Now, the question is us, what is a specified person? So we have seen point number C, clause number C, which says to a person in 13.3. Now I come to 13.3, which is what is a specified person. Who are the persons who are covered under section 13 to whom if undue benefit is given, that income will not be eligible for benefit under section 11. That is what we are studying right now. The author or the founder of the institution, any person who has made a substantial contribution, okay, to the trust or to the institution. So a donor is also a person in that extent. Okay. Now that contribution up to Finance Act 2025 was anything which is in excess of 50,000 rupees. That was considered substantial contribution. Now that has been revised from this financial year to 1 lakh in per year and aggregate rupees 10 lakhs during the lifetime of the institution. So that is a big change that has happened. However, if still the contribution is beyond the threshold, then that person will also be considered as a specified person. Third, where if the author is an HUF, then the members of the HUF are also specified person. CC is very important because that affects us. Any trustee of the trust or manager, okay, of the institution. So we have people in supervisory positions, in key positions. They are all categorized as CC. Any relative, and I have defined what relative is, of the author, founder, person has been deleted. So any relative of a donor is no longer considered to be a specified person. Similarly, any concern in which any of the persons above is holds substantial interest, which means interest in excess of 20%, then that concern will also be considered as a specified person. Here also, the B part, which is person. So any concern in which a donor as a person is kind of has substantial interest, that has also been deleted. So for people who are donors, there has been exception that has been made in the Finance Act of 2025 just to see that hardship is not there for them. Now, these are the people who are considered as specified persons, and what are the benefits that will be considered as undue benefit, and therefore the benefit of that income being applied will not be allowed in under section 11. One is that if you have given, this is part of the law in section 13. If you have lent any money without adequate security or adequate interest for lending that, if you have given your land, building or other properties to such specified persons without taking adequate rent. Now the adequate rent is something that you will have to explain and justify to the assessing officer. The point number C is most important. If you are giving any salary allowance or benefit to a person who's a specified person, which is in excess of what can reasonably be paid for such services. So now you have, can a board member receive a remuneration? Yes, a board member can receive a remuneration if there is a contract and that person has the required eligibility and experience and qualification, and the money that you are going to give them as remuneration is in line with what is experience and expertise or qualification or experiences in the marketplace. So that's very, very important. Okay. If the services of the trust has been provided without adequate remuneration, if any share security or other property has been purchased from that person at a higher price than the market price, or if something has been sold to that person at a lower price, if there is a diversion of funds, all those are situations in which the income that has been used for these situations will not be considered as part of section 11. Okay, so it's very important to understand the section 13. Now, this particular slide summarizes what we have seen in terms of income taxation, in terms of computation of income for exemption purposes. So I have chronologically arranged that for you as a summary, as a revision. First of all, the income and application has to be determined as book income or a commercial sense. It's not as per heads of income. So you get voluntary contribution, you get other incomes, you get donations. That is how the books are maintained. The that is the commercial sense or the book income as per books of accounts, as we record that. We don't record income by way of salary or house rent or that way. So we record that as per the commercial sense, both in terms of income as well as application of income for religious purposes or charitable purposes. Again, on the commercial sense. Now we will have to see that we can, so whatever we apply, whatever is our income and whatever we apply, 15% of that, after that 15% of the income can be reduced. So you have 100 rupees and you have 85 rupees as application point number 2, and you reduce 15% for income, the tax computation takes you to 0. All right. However, if your income was 100 and your second bullet was 70, then you are at 85%, which means that you will have to go to bullet number 4 in terms of the surplus of income over expenditure can be used, either can be considered as deemed application. Okay, you have to opt for it. It is not automatic, and you can spend that income in the subsequent years. That is what year that is called deemed application, or accumulated for being used in subsequent 5 years. So that is something that is part of the computation. Now these are the down below are other aspects of computation. Incidental business income, you'll have to present that. Then if in A and B, the option you have exercised, but you have not utilized, not applied the deemed application or accumulation within the timeline, then it will become taxable. Benefits to specified person has to be reported separately, both in income tax return as well as in your audit report. Funds, the one that we just saw, the previous slides, those are specified persons, section 13. Funds put in specified modes of investment, that has to be insured, because otherwise you will not get the benefit of corpus being treated as capital and accumulation being allowed for a period of 5 years. If the accumulation is not in modes of investment, then that will not be eligible for accumulation and will become taxable. Provision cannot be claimed as application, because all application in our case for not for profit is based on the cash principle, just as we do the FCRA accounting. Use of corpus funds. So if you have used corpus funds or you have used loans and advances in case you were falling short of income for purposes of application, that will not be treated as application in the year in which the corpus has been utilized or loans and borrowings have been taken. It will be considered as application in the year in which corpus is replenished or loans and borrowings are repaid. And the government has set a total time limit of 5 years. So if the corpus is replenished in the 6th year, then that corpus which you have used, it will not be considered as application. Inter-charity donation, which means if a 12A entity is giving to another 12A entity, that is inter-charity donation. Not allowed under FCRA, but allowed for domestic funds. The provision now is that 85% of the amount that has been given by the donor to the donee in inter-charity donation will be eligible application. However, the rest of the 15%, since the money has already gone from the donor to the donee, will also be accounted for at the time of computation. Carry forward of previous year's losses. So there is no possibility that in earlier years, if you had an excess of expenditure over income, which technically now is impossible, but earlier people used to take the benefit of excess uh, uh, deficit of income over expenditure, that route has been blocked. So that's not available. Okay. Your income of the year and the application of the year is what will be considered as numbers for your computation. So this slide summarizes all that we have studied in terms of, the previous several slides. So you can always refer to each of these points, and I've tried to curate it in such a fashion that it looks logical. Moving on now to provisions relating to maintenance of books of accounts. So you remember when we were seeing eligibility for Section 11 benefits, we said maintenance of books of accounts. Now, earlier in 12A, there was maintain books of accounts was what was mentioned, but there was no provision in law in income tax relating to what books you maintain up to financial year 21-22. In 22-23 financial year, or AY 23-24, Rule 17AA was introduced in August 2022, and it has four subparts. So that is where maintenance of books of accounts in for income tax purposes or for any reason whatsoever was made mandatory. Now, when you have assessment or when you are supposed to produce any books, you cannot say I produced them, I didn't produce them. You have to produce them because that's now a mandatory condition. Only if your income is less than than what is liable to tax, then that exemption is there. Now, what are the four subparts to the 17AA? It's very, very important. Financial year 22-23. Now, one is one is the books of accounts, and the second part of that is other documents. The books of accounts have been specified as cash book, ledger, journal, and your bills, invoices. So basically, they are looking at the accrual basis of accounting as the basis of accounting which should be followed. The other documents, which is part of the part one, is something which is very, very important to understand. And I'll read it out, not in great detail, but for you to understand what is it that needs to be maintained by not-for-profits in terms of other documents besides the mandatory books of accounts. Record of all the projects of that organization, institution, in case it's an educational medical institution, जो भी income of the organization आया during the previous year, you will have to make find you have details of who gave that income, who was the name of the donor, address, PAN, Aadhaar if available. Income from property held under trust, referred under section 11 of the along with list of such properties. Okay, any income other than voluntary contribution. Okay. So that is something that you need to have details. Once you have details of income, then comes application. What is the application that you made out of income? To whom was that money, was that income given? Those details have to be there. Have you opted for 11.1? Have you opted for 11.2 in case your application is not 85%? And if you have opted for 11.2, have you complied with point number 5 with 11.5 modes of investment? Or you have not complied. So all those details is something that you will have to maintain as other documents. Moving on. Uh, so similar to application, this previous slide, point number C is for the previous year, okay, which is the year in for which you have just ended for that year. But you may have situations where you have accumulation for previous years, how application was made for that accumulation. Any voluntary contribution by way of corpus. So we have seen point number 1 where we are talking of voluntary contribution. Please remember corpus is also voluntary contribution. Here for purposes of maintenance of other documents, corpus has been separately defined. Who gave you the corpus? Did you apply the corpus? What for did you apply the corpus? Did you keep the corpus in 11.5 modes of investment? or did you not keep the corpus in 11.5 modes of investment? All these details have to be given. Okay. Similar is the contribution. Forget this. Point number F is basically for religious institutions where all voluntary contribution has been defined as corpus. Okay. So that is the point number F. Basically, the Ram Janam Bhoomi, because of Ram Janam Bhoomi, this particular provision was brought where all voluntary contribution of a religious this thing is considered corpus. Okay. Now, so you have seen voluntary contribution by way of corpus. Okay. And what all details you need to have. Then you have similar to that the record of loans and borrowings. Did you take loans and borrowings? From whom you took loans and borrowings? Where? Why? How was the borrowings used? Did you repay the borrowings? Were the borrowings adjusted in the year in which it was repaid? All those details will have to be kept. Then point number H is properties held by the assessee, that is the organization, both immovable property as well as movable property. Okay. What is the nature of that property? Nature, address of the property, cost of acquisition, registration. Similarly for movable property. The number I is 13, 3 specified persons. Okay. Who are the specified persons? Did you give benefit to specified persons? And what are the documents to show that you gave benefits which was reasonable? Now, please remember, I'm again reiterating 13.3 benefit can be given, but the 1 minute, please, 1 minute. Sorry about that. So, those specified persons, they can be given benefit through a formal documentation and justification which you should have when the assessing officer may say that, well, this is unreasonable. Now, reasonableness and unreasonableness depends on how you are able to justify what is the size of your organization, what is considered reasonable by the size of your and volume of your organization. Something which is very reasonable for a large organization may be very unreasonable for a, so the benefit per se can be given. Reasonableness or unreasonableness is what is questioned. So that is the point number I. Now, maintenance of books of accounts, subpart number 2, how the form in which it has to be kept. So very flexible. You can have digital, you can have electronic, you can have printouts, you can have even electromagnetic. Okay. Place of maintaining at the registered office. At the registered office. If the accounts are maintained at locations other than the registered office, then the assessing officer has to be intimated that which are the other places. So if you have project locations and your accounts is being done there and your account books are being maintained there, then probably you will have to inform the assessing officer that besides the registered office, these are the other places. Fourth point is the period for which the accounts have to be maintained. Now, it says 10 years from the end of the relevant assessment year. So, for the previous year, including the end of this, including the following assessment year, 10 years, which means total of 11 years from the close of the preceding year is the time period for keeping the books of accounts. Now, in other laws, the time periods, especially FCRA, for instance, if you see the guidance is for 6 years. Please remember the income tax law in terms of maintenance of books of accounts, in terms of prescription, overrules all other laws. Okay, because the FCRA is also subservient in terms of income taxation to the income tax law. Now, if you have income, which is incidental income, then you have to maintain separate books of accounts is also what is said. Okay. Now, if you do not maintain the books of accounts, that is the condition that is there, it will not tantamount to, your income being disallowed completely. However, there is a new section which was introduced in 21, 22 financial year, which is called 1310 and 1311. Now it says, and it defines what are called specified non-compliance. Now there are three specified four
Mute and
actually.
non-content.
Please keep your mics on mute, my dear friends, please. And I need your 100% attention for this, please, because you will never be able to get these. The law for not for profit is very complicated. I am trying to make the law as simple as possible so that you can, at least when you see the law, you are able to actually understand some bit of it. And we have people who are professionals, we have people who are actually working for not for profits. So my intention is for the people who are working for not for profits primarily. Okay, so they need to understand, even though they may not practice it, in the sense that they may not be there to do this, but they must understand what they are doing in their organizations, and what their consultants are telling them to do or not to do is something that needs to be understood. This is primarily the education part that I'm looking at. So, continuing with the maintenance of books of accounts, the last part which is there says that if you do not maintain, so there section 1310 actually covers situations which are four. If your commercial receipts are more than 20%, and if you're not maintained the books of accounts, if you've not got them audited, and if you have not filed income tax return, will prior to introduction of 1310, which is a facilitating section, the entire income could be disallowed by the AO. However, after this facilitation was provided under 1310, these situations may still not mean that your entire income will be disallowed. However, your income used for the objects of the trust will be allowed with certain conditions, which are A, B, C, D, E, and F. These will not be allowed if you have if there is specified non-compliance, including books of accounts for not-for-profits. Okay, so uh, if you have met any income from corpus, then that will not be allowed. Loans and borrowing, similarly, it will not be allowed. Depreciation will not be allowed. Expenditure, to by way of intercharity donation will not be allowed. Okay. Uh, uh, Expenditure by way of 43 and 40 AIA, which we have already seen, cash payments and TDS, which will otherwise also not be allowed, will also not be allowed. Okay, and the expenditure will be allowed under section 1113 only, is what they are saying. Basically means that no other section benefit will be applicable. However, this is a very facilitating section for situations after assessment, with effect from assessment year 22-23, where four non-specified non-compliance have occurred. Still, the government is providing the benefit of section 11 to the extent of subject to these caveats. Okay. Now I move on to, so from the maintenance of books of accounts, we move on to the income tax bill uh, 2025, which has been introduced in Parliament, and uh, which is going to, in due course of time, become an act. So what in the ITB 2025 is some of the provisions related, I mean, some of the things that we must at least have a look at. It's a primer to the ITB 2025 in a certain sense. So I have tried to capture in the next couple of slides, some of the parts related to the ITB 2025 as it stands today. There will be changes, but what the ITB says right now is what we are capturing. All types of institutional entities or charitable entities, whether it's a society, trust, Section 8, university, they are given a single nomenclature that's called registered non-profit organization. Now, the entire law in the ITB talks about, only about the registered not-for-profits being, 1 minute. Registered not-for-profit organization being the common, name for all charitable institutions that are covered now. Second, so the entire law relating to not-for-profit has actually been kind of, uh, now, 1 minute. So the entire law is actually now in one chapter. So the for the not-for-profits, all law relating to income tax is now actually getting covered into one chapter, as against several splintered sections of which were applicable under income tax law. So the chapter is called Chapter 17B. Its title is Special Provision for Registered NPOs, and clauses or sections 332 to 355 are what covers the not for registered not for profits in this chapter. Now this chapter is divided into 7 structured subparts. Okay, so these are the ones that I have: A to F, A to E. G is what I have captured here. So all provisions relating to not-for-profits will now get captured in this particular chapter 17B. First is registration. So one good thing that has happened in the ITB 2025 in this chapter is that everything is kind of captured as tables, and that facilitates understanding and comprehension. Registration, what are the types of registrations? What are, so they have made tables. What are the registrations that are available? What are the applicable timelines within which these registrations have to be done? Conditions for approval and validity of registration or approval, as the case may be. Okay. Please remember, this talks about the registration as a charitable institution, not for purposes of ATG, which is another chapter, another subpart in this chapter. Income computation. So all the rules relate regarding taxability and the accumulation of income. This then actually says, how will you recognize income, how will you recognize application, and how will the income computation happen. It is more or less similar to what we have just seen as the slide on computation for purposes of exemption. However, it has been made part of one subpart so that that understanding is very, very easy. So third thing is, what is commercial activities? Okay, now our understanding is that pure commercial activities is something that has been done away in the ITB. So what this commercial activity it covers is essentially business incidental. Okay. And like the GPU category, that we had these two provisos, that two provisos have been brought in the commercial activities subpart. It is no longer part of the definition of charitable purpose. So the definition of charitable purpose in right now is 215, and the new in the ITB 2025, that in the definitions chapter, in the main definitions chapter, the chapter of charitable purpose is given in 223 instead of 215. However, the definition remains the same, except that the two provisions relating to GPU have been brought under commercial activities, subpart of this chapter number 17B. Compliance requirements. So all the compliances, okay, audit requirement, disclosures, books, filing of the return. So all that has been brought as one at one place. So 139 core A, audit requirements in terms of your 10B, BB, whatever. Okay, so that's all the compliance part. Then penalties and violations, consequences for non-compliance. So, 115 TD, 115 BBC, 115 BBI, all those sections which are here and there in the income tax law have been brought under one particular subpart. The next one is ATG. So this particular point number F covers deduction for donations under section 133. So the ATG is now called section 133. Okay, so section 133 as such is not part of this chapter, but it says 133 is the new section for ATG. So but it says, how will you regulate the tax deduction on donations to not-for-profits? That provision in terms of deduction is brought here in terms of 10BD and 10BE. Then interpretation, which is definitions and expression. So various words that have been used in this chapter have been defined more precisely, at least better than what we have today. A lot of times we have interpretational issues. So the interpretation has been brought to some extent in these chapters, in this chapter 17b, which is the new chapter under the income tax bill, which is expected to be rolled out from 1/4/2026. So it's not far away. It's not as though this is something which is theory. At some point of time, we will transition from the IT Act 1961 to this act from probably from 1 April 2026. So while I say that all these chapters, do they have great changes? The answer is no. Do they have a presentation changes? The answer is yes. That is what exactly we are trying to say. Some of the other things that I wanted to mention is that the the compliance requirements have been brought under one chapter. As we have seen, compliance requirements, compliance requirements, we had seen compliance requirements, point number D. What I'm trying to say here is the compliance requirement has been from the various sections as they came up over a period of time have now been clubbed under one. Okay, so taxability of NPOs, section 115 BBC, taxability of anonymous donation, which we have already seen, BBI, which we saw in terms of, non-compliance with 13B and C and D, taxability of certain specified incomes as they are called, section 115 TD, which is exit tax, which we have seen. This, all of them get consolidated under the same chapter or one of the parts of this particular chapter. So the understanding of what compliance needs to be done, and if compliance not done, then what are the repercussions in terms of penalties for violation are also specified. Um, Now the application of income has, both in terms of what constitutes income and both in terms of what is application of income has also been provided. Okay. So application will be what qualifies as application of income. Again, there is a table for that. The conditions required for the application of income, what will be the treatment of funds applied from corpus, okay, and their replenishment. So all those provisions have been captured. Similarly, point number nine, no, not point number nine is five is something different. Similarly, like the application, the income has also been kind of, point number nine. Regular income has been defined, just like what constitutes application. Income has been defined in terms of receipts for charitable activity, voluntary contribution, incidental business income. Now, if we see the definition of income, the incidental business is what is coming, which means indirectly the government under the ITB is saying, well, commercial activity not permitted. Absolutely, because there's no mention of that, which means that, it there is little room in terms of looking at commercial activity. Next, point number five, the deemed application concept has been eliminated. You saw that if our section 11, uh, uh, 85% is not spent, then under section 11, you had 1 and 2. 11.1 is deemed application. That concept is being done away with. So you have only the accumulation of provision now under the ITB 2025, whenever it gets notified, okay? Or whenever the applicability gets notified. Now, the purpose. So if you remember, I had last time said that when you do 11.2 accumulation, you will have to define the purpose, okay, of accumulation. Now, this definition of the purpose has been done away with, okay, because it also includes deemed application, probably because of that. In deemed application, you do not have to specify purpose. But in accumulation, you have to specify purpose. In deemed application, you can still do inter-charity donation. In accumulation provision, you cannot do inter-charity donation, which means that if you do accumulation under the ITB 2025, then inter-charity donations from accumulated surplus will probably not be possible. So there are those, repercussions that will happen as these provisions are rationalized, and they get culminated or they get collapsed into more broader. The government has realized, well, the income tax for not for profit is a big maze, actually because of the fact that over a period of the last 50 years, all provisions have come, at different points of time. This is a great boon in the sense that, well, all provisions now get merged into one section, one chapter. Okay. Uh, so within your registration mandate, any objective you can do. You remember 11.2, presently you have to do the purpose. You have to say, I will use the accumulation for this purpose, and it has to be specified in, in your form 10, and it has to be complied with. Only last year, year before last, there was a relaxation which said that if you want to repurpose the objective for which you have done accumulation, you will have to go to the assessing officer and get the repurposing done. Prior to that, there was no repurposing also. Okay. So this is something that I just wanted to tell you. Continuing with the income tax bill, anonymous donations are not applicable only to religious institutions now. Earlier, we had seen in 115 BBC when we were doing the definition of anonymous anonymous donation, we had seen that religious come charitable institutions can also get benefit of anonymous donation if they are not running a medical or educational, not to the extent of anonymous donation for medical or educational institution. This particular category has been removed. So now only anonymous donation can, will not apply to religious institution, but it will apply to to charitable and charitable come religious institution. Please remember that charitable come religious is not a category. It is not a category of charitable institution. The charitable institution is based on your objects of charitable purpose, which does not talk of religion. Okay. So if you are doing religious come charitable activity, then please remember that benefit you will get only under 80G5B. Okay. If you are only registered under 12AB and not registered under 80G, that benefit of religious come charitable will not be possible because the religious come charitable is driven by 80G 5B. Now, another point that I want to say is that 15% of the income that you can set aside, I call it standard deduction for the charitable institution, the kind of standard deduction that we get for our personal taxation. So 15% is now, set aside. That set aside 15% is what? 100 rupees you got as income. 85% if you apply, 15% no questions asked. You can apply 100%, no questions asked. If you apply 85%, there is no question of any taxation because the 15% the government says well is required for pursuing the objective of that organization. If 100%, then what is the kind of funds that are available for an eventuality or for a contingency? That's primarily the idea. So the 15% is now christened, as now called deemed accumulation income, deemed accumulated income under the income tax bill. And please remember that this deemed accumulated income, this 15% did not have any compulsion in terms of modes of investment, but the deemed accumulation income under the new bill, under the new law, will have to be invested in specified modes of investment. Now, the specified modes of investment have also been specified. Section 11.5. That's also specified in the new IT bill. Regular income, as I have already said, is also defined. So the definition of application and income have been more precisely stated there. Now, as we understand, application from corpus, loans and borrowings, okay, will not be considered as application, is something that the plain reading of ITB 2025 is giving. Now, we might have some changes here, but at this stage, it can be a very major challenge if this is not considered as application at all. Delay in audit report, okay, is not a specified non-compliance. So we had just seen non-maintenance of books of accounts. There is this section 1310 which says your income computation or your computation will be based on a certain mechanism that is given in 1310. Now, what were the specified non-compliance? Non-maintenance of books of accounts, non-filing ITR, non-submission of audit report. The non-submission of audit report is under the new income tax bill no longer a specified non-compliance. So what is specified non-compliance? More than 20% commercial, non-maintenance of books of accounts, and non-filing of income tax return. Okay, so this is something that you need to know. So these are some of the features of the new ITB 2025 as it will apply to charitable institutions. Now we come to the session 2, which where the layout is something like this. We will see the income tax forms, returns, and proceedings in as an overview. Okay, then we will do the TDS provisions as they generally apply to the not-for-profits, not all. And the thing is, the last thing that we will do is other miscellaneous provisions right now in the income tax law, which are applicable for not-for-profits. Okay, very important to know that they are all scattered here and there, and but whether they are applicable. Some of them have got deleted from this year. We will also see that. Now, as far as a not-for-profit is concerned, there are four kinds of forms and returns that, I mean, basically returns that need to be filed. Now, these returns are different from the forms that I will also refer to. The return is the return is basically the income tax return. Okay, the forms are several. Now, what are the forms that are normally filed by not-for-profits? You have seen form number 9A and form number 10, which is deemed application and accumulation. Now, this is in case you are not able to apply 85%, then this is the situation that will occur. This date as per the act was 31st August. However, the CBDT last year gave a relaxation without specifying any particular year, and therefore it is being considered as applicable for all years. That instead of 31st August, they said as long as these forms are filed before the due date for filing of the ITR, then they are good. They can be considered. However, the Act mandates 31st of August. Okay, this is something that I just want to clarify. Form number 10B and 10BB, we will see a bit of it in the next slides. This is the audit report. The due date is 30th September unless extended. Now, please remember, as far as Form 9A and Form 10 are concerned, these are forms which are optional. Two forms which are also to be filed every year, as we had seen in the first session, was 10BD and 10BE. We have seen those provisions. Those are mandatory forms. Okay. Now, a lot of people ask me, well, my donor is not going to claim ATG benefit. Should I, file 10BD? The answer is yes. My FC funder is not going to take any benefit. Should I file? The form 10BD is your responsibility. Generating 10BE receipt is your responsibility. Whether the person claims ATG benefit or not is that person's privilege. Okay, so that needs to be clearly. I today was going through some due diligence where the guy, writes back to me and says, we checked with our uh, donors and they said that we don't claim ATG because it was inter-charity. I don't know how people come up with so many explanation to everything. Now, if you have not filed 10BD and you have filed income in your ITR 7 and you are obliged to file 10BD, okay, is something which can lead to an interpretation that this is anonymous donation. Okay, so as long as you do not report, so it can go any which ways. Anyway, so 10BD and 10BE are mandatory forms. You will have a form 10AB, which is your renewal form, which is due on 30th of September 2025, which is your renewal, which has to be filed separately for 12AB and ATG. Okay, so please remember, these are all kind of forms that normally not-for-profits have to file. Now, the form 10B and 10BB is also a mandatory form. However, it is getting diluted under the ITB 2025 and there is this benefit under 1310 in case there is audit report is not there. But But I think the government sooner or later will, take away this 1310, which is only for purposes of, bringing people to kind of comply. Now, ITR 7, so the due date for 10B and 10BB, which is your audit report, annual audit report to be filed by the auditor and signed off by you, is 30th September. Your ITR 7 is your form as a 12A entity. Okay. If you were not a 12A entity, if you were not registered under section 11.1023C, now no longer existing, then you will file under ITR 5, which is, other AOPs, AOPs or BOI. But if you are a 12A entity, then you will have to file under ITR 7. The due date is 31st October. Now, I will show some details. I'm not getting into 9A and 10, which we have already done, because we have already seen what is 9A and what is 10. These are forms when your application falls short of 85%. Okay. Then the other forms, 10BDB, is for your statement of donation and your donation receipts. The 10BBB is your audit report. Now, coming to the audit report 10B and BB. Now, there was a big change that happened in assessment year 23-24. Okay. Uh, so from 23-24 assessment year, which means 22-23 financial year, the audit report format has gone tremendous change. Okay. Prior to that, the audit report format was very simple. There used to be two forms of audit report. One is form 10B, which was applicable to 12A entities, and 10BB, which was applicable to 1023C entities separately. Now that distinction has been taken away. This distinction does not, is not there at all. So any category of registration will attract either 10B or 10BB, not separately. Now, what are the conditions in which section form 10B has to be filed? Three conditions, okay, and with an or. One, the total income exceeds 5 crores during the previous financial year. In case the institution receives foreign contribution, and in case the institution has applied its income outside India in the previous year. If any of these conditions are attracted for that, previous year, then form number 10B has to be filed. If either of these three are not attracted, then 10BB has to be filed. Now you'll have to see which is the form that will be applied, and the form can change. One year it can be 10B and the other year it can be 10BB. Okay, so that is something that has to be understood. Now there is no relationship between 12A and 1023C in terms of 10B and 10BB. No longer it is there. Okay. Now, as far as the 10B form is concerned, it is a very elaborate form. It is like the assessment order in a certain sense. So the department actually is asking you to do the assessment only through this 10B form. Now, if the 10B form has 49 clauses and 28 schedules, huge form it is, and it captures everything virtually and is like an audit report, in a certain sense, true audit report, because the independent practitioner has also to say in that 10B form, which was not the case earlier. And therefore, this 10B has become the audit report generally, saying that it's true and fair condition has to be, true and correct opinion has to be given in that audit report by the auditor. And to that extent, the auditor is also dragged into the income tax based on this certification that it gives in 10B. The form 10BB is a simpler form. It has 32 clauses and 5 schedules, not less anyways. But what the government is trying to do is to ensure that you understand these various clauses and answer properly, and also that this answer should match with what you are reporting in your ITR 7. So because at the time of assessment, there should not be any difference which gets caught, and therefore there is a problem for you. So the 10B and 10BB audit report format, it's very important for you. I'm not saying that people who working in organization, most of you are like that, are the ones who have to fill this. But at least see the preview of the form that the consultant will fill up when you do before it is filed and signed off by you. That is what I'm trying to explain to you, so that at least you know that the figures that have been given there are matching with your financials. Okay, so due date is 30th September, and we move on from here to the document called ITR 7. Now we have seen that the income of or application of any not for profit is based on the commercial or sense or the business income as per books, or the book income basically. So you don't have heads of account the income, that the conventional five heads of income that we have. That's not the case as far as ITR 7 is concerned. Okay, so basically there are three types of income of not for profits. One is aggregate income, one is what is called as voluntary contribution, and the other one is called as capital gains when you sell a capital asset. Okay, so all so-called heads of income that are otherwise in heads of income are collapsed into these three broad book incomes. Aggregate income, which will comprise of everything other than what is voluntary contribution. And the voluntary contribution is also inclusive of corpus. Now, ITR 7 is for all kinds of charitable institutions, charitable, religious, charitable, uh, and religious, political, electoral, funds, um, parties, political parties, scientific institutions, all of them, university, colleges, electoral trusts, everything is covered under 11 ITR 7. So that is again a 50-60 page ITR. So you will have to see what is it that is applicable to you. And for us as 12A entities that we generally are, please select section 139(4)(a) because that's the section that is applicable for us. And all our computation on assessment will be based on whether we select 139(4)(a) or other sections. And therefore, you may have demand or faulty return. So one has to be very careful. A lot of organizations that I talk to when we do due diligence say that when we have filed the ITR return, that is all that we have to do. We don't have to bother whether assessment will happen or not. And they don't even know whether assessments have happened, proceedings have taken place, or what has happened. So it's very important that the ITR 7 is not just considered to be a return that is filed and forgotten. You will have to see what did the department do when you file your income tax return, personal income tax return, you get an assessment order. You are always curious, what is my assessment order? Is there an extra demand? Is there a refund? Or has the department accepted my numbers as it is at the time of CPC processing? Okay. So similar to that, you will have to see for your organization. Now, in ITR 7, there are two parts. Part A, general, and part B, which is the total income and total tax computation. Now, part A is comprises of most of the details that are required. So the details of the registrations or approval, you have to again be very clear that you tick the right code and provide the right detail of your registration. Okay. Uh, uh, FCRA registrations, any details about your board, details about your auditor, all that will be part of the initial general information. Then there are schedules, okay, which you will have to fill. So the schedule I and IA is basically related to accumulation, okay, set aside accumulation and tax, okay. So accumulate the matter related to accumulation, which is 5 years, is to be reported in schedule I and IA. Similarly, deemed application has to be reported in schedule D and DA. Schedule J gives details of your corpus investments and your loans and borrowings. And there is a schedule R following schedule J where you'll have to reconcile the corpus with the balance sheet. So the details of the balance sheet will have to be given in the table and the corpus has to be reconciled. Schedule VC is voluntary contribution, grants, donation, and corpus. All of them in voluntary contribution. Okay. Then schedule AI is the aggregate of income, excluding voluntary contribution. Now, sometimes I see that voluntary contribution is also added to AI, which is incorrect. All incidental income from activities and interest income. So you get rental income, you get interest on your deposits or whatever. All of that will be part of AI. Then in terms of application, or you have schedule ER and EC, which is revenue expenditure and capital expenditure. And the same schedule also will ask you to explain how did the revenue expenditure get, met? How was the expenditure met for this particular revenue? Okay. So what were the sources to meet the revenue expenditure? Okay. Similarly, schedule EC, what were the capital expenditure and what were the sources to meet the capital expenditure? Was it from current year's income? Was it from previous year's income? Was it from deemed application? Was it from accumulation? Those details have to be provided. Okay. Uh, Now, schedule TI and TTI are the tax computation that I talked about, which is basically computation of income based on all the schedules that you have seen, and is there any computation of taxes and details of taxes paid. These are the details that have to come in your ITR 7. Details of all your bank accounts. We had seen our 12AB registration certificate that you need to provide these details. Expenditure incurred outside India, provisions, all this has to be excluded. This has to also be reported, but will all be taxable. Okay. In fact, outside India will be taxable. Provision will not be allowed because now from 2000, I think 22, only cash payment will be considered as application. So the details of your profile need to be checked. And the last thing is, your order status, your assessment status, your proceedings should be checked from time to time. Now, this last point is the most important point where I see most organizations, lot of organizations just don't have the login credentials to their portal, whether it is to TDS portal or to the e-portal, income tax portal. They don't have this. Okay. So I sincerely request that you must get the login credentials, even if you don't use it, at least once in a month, see any proceedings, any demands, any information, any communication that has come. Sometimes the communication might go through mail or to the designated as an SMS to a person. He may see, not see, but the concerned person in finance and accounts should have the login credentials and at least see, so that at the right time you are able to take action rather than allow the limitation to cross and then request for condonation. So this is ITR 7, and I go now to the 26 AS, AIS, and TIS that you must know. So all of you know 26 AS. Basically, it is the information associated with your PAN. What are the taxes that were deducted? What were the taxes that got collected? What were the high value investments that were made? Any purchases, any income that you got and the tax was there? All that is part of 26 AS. Now, 26 AS was our go-to document up to 2020. So every person who has a PAN and where there is a deduction, and when we will see TDS, all that deduction will get reflected in the 26 AS as a credit. Okay. In addition to several other information. But this 26 AS was overhauled by what is called as the annual information statement or the AIS. And I request that every organization, person working in an organization, I mean, you yourself for your individual PAN should also see, but for your organization, please see the AIS before you close your accounts. Okay, so in 2020 it was introduced, and this is an extended version. This is an extension of 26AS. So for all practical purposes, the AIS should be your go-to document in terms of finally seeing that everything gets reconciled. Now, the AIS gives details of savings account, interest, dividends, any capital gains, rent received, purchase and sale transaction of securities, immovable properties, specified financial transactions that you do, which are reported by those agencies with whom you have done, that will also get reported. Foreign remittances, okay, interests and deposits, GST turnover is additional that you get in the AIS. Please remember that if you are doing GST, that will also get reflected in AIS, which means that if you are doing any incidental business or business, you have to be very careful because the department will have all this information. Now, so the AIS can also be have a provision for feedback, whether you agree or don't agree, or you say that there is a problem. The TIS or the taxpayer information summary is more extracted from the AIS. So for all practical purposes, all incomes that you get, including the interest income that you get on savings bank account, you will not be able to, conceal anything today in the situation where AIS is available. That is what I want to say. Even if you conceal, then automatically at the time of processing, 143(1)(a, notice will come to you, which means that there is a discrepancy between what is available with us and what is being reported by you in your income tax return, whether it's ITR 7 or any ITR 1, 2, whatever, or 4, whatever, wherever. So basically, what I'm trying to explain to you is that the annual information statement is your information, your income information, as well as several other informations. Okay, that is what we want. We should check before we proceed as far as our income tax returns and other things are concerned. Now, the TIS is basically, as I said, it is it is extracted from AIS, and it has two columns for various, income sources, sources of income being salary or interest. So there is something called processed value and something called derived value. Now, the processed value is what the department has got, is feeding, and the derived value is the value after considering the taxpayers' feedback. So the processed value is something that you will have to say whether you agree with or not, and then that becomes your derived value for purposes of filing your income tax return. That's what this TIS is actually. Okay, so it only tries to summarize what is the income that is available from various sources that have fed that information in your PAN versus any discrepancy that might be there before you are filing it. So this is another opportunity for the TIS to actually just give give a you know a similarity between the two values, so that then subsequently there is no problem. So please remember, these are three. I mean, you understand 26AS, but the AIS is probably your big document. I am now doing just one slide in terms of IT proceedings, because I see a lot of organizations, when any income tax proceeding happens, then there is a lot of, commotion, what to do, what not to do. So on this slide, I have tried to put some of the sections. I have had situation where under 143(1), a notice has come under 143(1), which is summary assessment. Nothing has to be done. So the guy comes back to me and says, what do we have to do with this notice? What action needs to be taken? So our understanding of IT proceedings is based on our ITR that has been filed, which needs to be assessed and through various sections. 142(1) is if you have filed your ITR and the assessing officer, or not filed your ITR and the assessing officer needs your additional document or information or your return. 143(1) is the summary assessment of the ITR if it is properly filled and matches with the details available with the department. then the centralized processing center will throw up your 143.1 notice as an intimation saying, well, we have seen there is no change, you have a refund or there is no liability. Okay, that is generally the case in 143.1, or if there is a demand because you have wrongly calculated. 143.1a is based on your ITR file. Okay, if there is a discrepancy, then that notice will come. 143.2 is when there is a, you know, when a notice has been sent by the assessing officer for scrutiny assessment. Although 143.1 assessment will be done, but then that will be followed up via 143.2 notice saying we want to examine your books and all your details more because we are still not satisfied. The outcome of 143.2 scrutiny assessment is the 143.3, which is your assessment order based on scrutiny assessment. In case of 148A, which is income escaping assessment, so that can always be, there can always be a notice where the assessing officer, uh, from the end of 3 years from end of assessment year, in case it's 50 lakhs, and 10 years if it is more than 50 lakhs, can issue a notice and call for open that assessment. Section 245, if there is a refund pertaining to, a particular year, the current year where the assessment has been made, and there's a demand, then you might get this notice which says, can we adjust, we will want to adjust this refund against the previous um, demand. Similarly, 270A is basically concealment. These are proceedings for, not sharing or under reporting. Okay, these are very, very stiff. Now, intimation under 154, sometimes you get under intimation under 154 once you have filed a response where the assessing officer may want to correct a mistake and give effect to whatever representation you have made. Now, please remember that if there are in your portal situations where there is a lot of proceedings pending, our suggestion will be to please clear all those proceedings as far as possible before you file your 10AB form. Because when you file your 10AB form and during the process of inquiry when it happens, I'm not very sure how much inquiry can happen and at what level the inquiry can happen. For maybe 20, 30 lakh trust, how does the department have the bandwidth to do it? But anyway, they have said it is based on process of inquiry. So, or it might just be that you file this form and this time they let you go. But our suggestion is that the one of the considerations for renewal of registration under 12AB will be how clean your track record is in terms of, income tax compliances. This is going to be a very major factor. And so understanding your provisions and understanding your compliances under income tax is very, very important. I now come to the next part relating to tax deduction at source. So basically, tax deduction at source is a withholding tax. I can tell you that the track record of organizations as far as TDS is concerned is very, very poor. And a lot of organizations just blatantly say it does not apply to me, as though they have the authority to say that. And I find that one, because of the cash basis. Second is because, there's a lot of cash involvement. There is no understanding of TDS. We also know that 40AIA, the non-deduction, short deduction of TDS also has implication in terms of disallowance of your application and being taxable at 30%. But the track record of organizations is very, very bad. Now, there are three reasons why withholding tax is done. One, that the government wants revenue. The government has to run its establishment for 12 months. So where does it get the money for running that for 12 months? It's through withholding tax. As one of the sources. I'm not saying that's the only source. As one of the source. Second is to check tax evasion. So because the entry gets captured or the withholding tax cap gets captured in the system, The person who has to report that income on which withholding tax has been charged will not be able to, because it automatically will go to his 26 AS, okay, or its AIS, whichever may be the document. And the third thing is that the government wants to widen the tax base. So the government is not only taxing income, but in certain cases, they are even taxing purchases. I mean, goods basically. So 194Q is one such, although the percentage is very small, but where in, so what can you tax? You should be taxing income. Okay. And what can you withhold as tax? As withhold a tax which is otherwise chargeable on income. But that may not be 100% the true story as far as TDS is concerned. So the TDS family in chapter 17B, current chapter 17B, is, getting more and more additions in terms of, the sections for deduction of TDS. Now, we need to understand the difference between TDS and TCS. Okay. And on TDS, we will do few of the sections which are generally applicable, generally 4 to 5 sections, and then some more sections under TDS which are also applicable is something that we will do. Now, as far as TDS and TCS are concerned, TDS is tax deduction at source. Okay. So it is generally deducted from income. It is deducted by the payer. So the payer is the one who's making the payment is the deductor. The other person is called payee or deductee. Okay. Then, uh, it is imposed when the payment or the income crosses a threshold. So most sections in the TDS family have specified what are the threshold which will get crossed, and then that particular TDS will be applicable. 24Q, 26Q are generally the Q forms, 24Q salary and 26Q other than salary. Although there are more forms in the TDS family, but these are the two forms as organizations that we need to do. Now, how does the TDS thing work? We have seen 26AS. 26AS is your PAN, a PAN based, detailing. Now, when you deduct any income, any tax, when you withhold any tax from income, okay, then you need a TAN, or as an organization, you need a TAN, tax deduction and collection account number. Now, the TAN is mandatory if you have to do TDS or TCS. Why? Because you cannot withhold the tax and put it in your PAN. You have to transfer that amount of money that is the withholding tax. That's not your income. It is only an amount which we have kept to be passed on to the person from whose income we have taxed at through a certain procedure. So what happens is that whatever TDS we deduct, that TDS is deposited, okay, through a challan, okay, normally the 281 challan, and through that challan, it gets credited to our TAN, TAN. So whatever money we have collected by way of TDS, that money is then getting reflected as a credit in our TAN. That is one part of the story. It cannot be deposited in my PAN because my PAN is my PAN. I Others people's income cannot be in my PAN. So I cannot be depositing directly in their PAN. So I give credit to of that amount will get credited in my TAN. Procedure number 2 happens is that we have to file quarterly TDS returns. So the TDS challan, as we will see, has to be filed every month. For TDS collected, that has to be deposited. And every quarter you have to file the TDS return. Now, what does the TDS return does? The TDS return takes the credit from the TAN and passes on the credit as a credit entry to the respective PAN of the person from whose income you have deducted tax. And that tax that has been deducted is showing as a credit in their 26AS, which they can use for purposes of adjusting against their tax liability or can claim refund. So both the TDS challan as well as the TDS return are the two specific documents, and the TDS return is through the traces portal and the TAN deposit is through the e-portal. Now, why I'm trying to explain is to you is to explain what is this concept of TDS? Why do we do this TDS? Why should we even deduct this money is some question that can come. हमें क्यों deduct करना है? This is their income. Why should we keep this income and then do all this? The duty has been cast on the person who's making payment to deduct this and then deposit. And also not only deposit, but also ensure that the credit is passed on from the TAN of that deductor to the PAN of the deductee through a mechanism of what is called as the quarterly TDS return. This is the simplest explanation of the process of TDS. That is what I want to explain. Now, so once you get that understanding that I have tried to give you, you will understand the entire TDS process in the simplest of fashion. Okay, this is our duty. Now, there is no understanding in many organizations about TDS at all. नहीं लिया, अब apply करेंगे, then they start applying for TAN. They have not even accounted for any TDS actually. So, slowly as the analytics get stronger and data more and more is available, I think all these positions will get, knocked off. And it is very important that we comply with the TDS provisions. Now, as far as TDS is concerned, in TDS, we saw who's deducting the TDS, the person who's paying. Okay. Now, in the case of tax collection, the collection is done by the seller. It is collected by the seller. So the seller who's making the sales is collecting from the buyer this TCS as an additional amount when he is making that invoice and depositing that in the PAN of the purchaser. These are situations where 206C provide for the goods and services which are under, you know, uh, section 206C. Now, generally, we do not do tax collection at source except when we do deal with non-farm timber produce. Why is this 206C there? Because the purchaser may not have the requisite, ability. It may be, an agriculturist or maybe a person who's not that good. So the seller will deduct, will collect and deposit that TDS, TCS. Now the TCS return is 27 EQ. So the difference between the two is the other way around. So whatever you deduct as deduction by way as a payer, you have to pay. That is the tax collection at source. Now coming to the TDS provisions, I'm going to do 4 of them. The section 192 on salary, 194J, okay, the section number 194I, the 194C. These are the 4 sections which, when we deal with not for profits, these are the sections which are mostly applicable. And some of the other sections is something that I'm going to do with you. But these are the 4 sections which you would normally do. Now, 192 is for salary. So whenever you are paying salary, now when do you pay salary? And here also there is so much confusion in terms of the method or the basis of engagement of manpower by not-for-profits. Our understanding is that wherever there is an employer-employee relationship, which is depicted through a contract of employer and employee, then that particular payment falls within the definition of salary. Okay. So the rates are declared from time to time every year in the Finance Act. Okay. Uh, and these are the rates of TDS on salary. So you might have a situation where you have engaged people on contract, but your engagement contract is like an employment contract. So in that case, it will be treated as a 192. So if you are engaging people on contract, please also see that your engagement contract does not look like an employer-employee contract, or does not say appointment of on the post of so and so. Then it's an appointment contract. So if you want to bypass 192, then you will have to not only see that the employer-employee contract relationship is not there, but it is also not documented in the form of an employer-employee relationship. This is the old regime. Dhire dhire, this regime is going to become defunct and is replaced by this regime. The current taxation rates of tax for financial year 25-26 is what you are seeing here. This scheme is being made more and more sweeter compared to the previous regime. Okay, 1 minute. So the previous regime had all kinds of deduction eligibilities. The new scheme does not talk of eligibilities at all. And the rate of taxation is much lower at the margin mostly. And the slabs are also more attractive. So up to 12 lakh rupees or 12 lakh 75,000 rupees, there is no taxation in the new scheme, which is a big advantage versus the old regime. And this is the default regime. So if somebody does not want to opt, then this regime will be treated. But it does not give you any benefits under Chapter 6A, which is the 80C benefit or the 80D benefit. However, you will get benefit of standard deduction, which is also at a higher amount of 75K now versus 50K for the old regime. And you will also get the benefit of 80CCD2, which is the employer's share of NPS. Now, you will not get benefit of 80CCD1, which is basically your contribution to NPS, which you can get up to 50,000 rupees in the old scheme, old regime. So what I'm trying to say is that you will have to get the employee to, if they do not file any declaration in 12BB form, which is your declaration of income every year that you should get in April, then the default regime is this, or the tax regime is this. Simple. And you will compute the tax for that year based on this, which is very simple. However, if you do it on the old regime, then you will have to account for benefits under Chapter 6A and account for them at the end of the year in March to see whether those 6A investments have been made and then compute. So if there is no, you know, the new regime, then the tax estimation is as good as tax actual. Now, this is one slide where I just want to tell you that if you have 1275, then you basically do not have any taxation, but because you get that benefit under 87A also. Okay, so the benefit is say up to 12 lakhs. There is no under the new regime there is no taxation, which under the old regime is still 5 lakh rupees. So the government is trying to dissuade investment by individuals in a certain sense and promote consumption. So I'm not saying good or bad, but you will have to see which is the regime which is beneficial for you. Obviously, for incomes which are up to the 12 to 15 lakhs or even 17, 18 lakhs, which is generally a slab for salaries, the new regime is the default better scheme. Coming to 194J, now I want to also say that in the salary thing, not for profit organizations do not have any understanding of when to apply 192 and when to apply 194C and when to apply 194J. So even if a person is doing some routine work, which otherwise is in the nature of contract, those guys are deducting 10%, saying that we think they are consultants. And the appointment and the letter of contract that is there may be actually an appointment contract, appointment letter. So all these things need to be understood, not just in terms of the tax provision, but also in terms of the documentation and the way the contracting has been done. Now, as far as 194C is concerned, you, all that you get done on contract is what is covered here. So these are what are, you know, mentioned: advertisements, broadcasting, catering, contract manufacturing, manpower. So the manpower is something that we do contract. Our engagement with this particular person is on contract. However, please remember that in the new labor codes, engagement of contract labor for core activities is being terminated. Similarly, carriage of goods and services. If the agency does not have more than 10 vehicles and has a PAN, then there's no deduction. So these are, if you have any AMC, if you have any maintenance, all that will be part of this contract thing. Now, when you have contract manufacturing, and if the invoice is a lumped invoice, then the TDS will be on the total amount. Where it is separately recorded, then it will be on the service component. However, if the material is provided by the person who is going to be the purchaser or the associate of the purchaser, then the material will also be taxable, is what the judgments are now. There will be no TDS on GST. So there's no taxation on taxation. Sometimes I find that when there is a bill which comes with GST, the TDS is deducted on the gross amount. Please remember the DGS will be deducted on the taxable amount. GST will not be taxed. I see a lot of this mistake also happening. 1% if it's an individual or HUF, and 2% other than individual or HUF is the TDS. What is the threshold? Single invoice not more than 30,000 and total of all invoices not exceeding 30,000 each, not total exceeding 1 lakh in a financial year, no TDS has to be deducted. So suppose you have 25,004 invoices in a year, nothing has to be done. But if you have 32,000, then TDS has to be deducted. So this threshold has not changed as the other thresholds have changed. Okay, so this is 194C. 194J is essentially for professional and technical services. Professional services, professional services, FPS is 10%. Fee for technical services is 2%. Data call center is 2%. Generally, we might have a telecalling kind of a service that we might take. Okay. Uh, it's generally not, this is basically for domestic companies. Now 10% and 2% are the rates for fee for professional service and fee for technical services, and this becomes complicated. Where do I categorize my service that I have rendered as a professional or technical service? Now, before we do that, the 50,000, the 30,000 threshold that was there up to March 2025, has been increased to 50,000 in a financial year. Okay, that is the uh, threshold now from 1st April 2025. Now, as far as the distinction between professional and technical services is concerned, I have tried to put that in terms of definitions in the Act. Okay, so that it helps you to decide what is professional and technical services. If still there is confusion, opt for the higher rate. So professional services, because in any case, this rate, this tax is withholding tax. And this withholding tax has to be adjusted against tax, either as against tax liability or claimed as tax refund by the person from whose income you are deducting. It's not something which is lost. So you have to explain only that it reduces the availability of funds with you, with that person whose income from whose income you are withholding. Legal, medical, engineering, architectural, accountings, technical consultancy, interior decoration, advertising, advertising, or such other professions notified by the board. Okay. Now, 44 AA has added more. So, for instance, a company secretary's profession has also been added through the 44 AA, and there are several other, services that have got added. So you can have a look at that. Now, when it comes to fees for technical services, then FTS is rendering of managerial services. Managerial means you are running somebody's business or managing somebody's business. Then it is technical services. Now, here the technical service means any technical expertise that you have. Now, that technical expertise may not be purely medical, legal. You have that technical expertise which actually is not distinctly specified in professional services, or consultancy, something by way of advisory services that you give. All this will be considered as FTS, okay, other than salaries, of course. So, when it comes to understanding professional service and technical service, it is good to have understanding of these two. Sometimes they might overlap, and in that case, erring on the side of higher rate will be better. Sometimes technical expertise may be difficult to justify, or unless you are very sure that it does not fall under professional services, but he has that technical expertise, okay, which is basically because of his skill, or he is into advisory business. Now, that consultancy work that you have given by way of advice is fee for technical service. That is how I will explain it. Now, as far as rent, the 194I is concerned, this is rental. Okay, plant and machinery 2%, and buildings and appurtenances attached to building and land. Even rental for land is part of 194I. Here, the amount has been revised to 6 lakh rupees from 2 lakh 40,000. But with a caveat that if in a particular month, the rental is more than 50K, then the TDS will be applicable. Probably on the assumption that if it is 50K, then for the year it will be more than 6, or it will cross 6. Okay. So those are the conditions, two conditions that you have to see. Section 195 is when or NGOs make payment to non-residents. Non-residents for purposes of any technical services, royalty, dividend, of course, companies. This is subject to checking of DTAA conditions. Now, what I'm trying to actually say is that a lot of organizations might be paying foreigners who are defined as non-resident Indians in this section. Now, what is a non-resident? Sorry, not non-resident, non-resident. Don't please ignore the word Indian in this. Non-resident. Okay, I have wrongly written Indian. So when you engage a foreigner or a foreign company for any kind of technical service, okay, and you are making payment, the technical service has been rendered in India. So the benefit goes to India or your organization or to the community. Now you'll have to see the double taxation avoidance agreement that India has with individual countries, mostly technical services, UK, USA, most of these countries we have DTAA. And therefore, generally the rate of taxation is about 10%, which may be higher for these services, but generally based on DTAA, you will have to see there is no threshold and the definition of Indian has been provided. So anybody who's not falling into the definition of Indian is a non-resident. The Indian definition is an Indian resident 182 days in a year, 60 days in a year, and 365 days in a block of 4 years. If that is not the case, then 195 is applicable. Okay. Now, please remember a non-resident Indian by the status of non-resident, okay, will also be within the purview of 195. Because he is a non-resident, he is not a resident Indian. So NRI also, if he is providing any services, will fall under this particular section. Now, there are thresholds in terms of declarations that have to be provided in 15 CA and CB. You will have to provide that on the portal. If it is the amount is up to 5 lakhs, then you'll have to file form number 15 CA, deduct TDS, file this form 15 CA on income tax portal, deduct TDS, and give it to your remitting bank for remittance to that non-resident. If it is more than 5 lakhs, then the 15 CB has to be filed in addition to 15 CA by your chartered accountant. You will have to check the DTAA conditions. Okay. You will have to file this with the department, that is the income tax department, and provide it to the bank for remittances. Okay. The report, the TDS return is 27Q for 195 section payments. Please remember, one has to be very careful in terms of deciding applicability of 195 or non-applicability of 195. The status in terms of total period of residence of that particular person is important. So a non-resident will also be non-resident in the definition of for purposes of 195. Now coming to, so I'm going to skip a few, not skip, but do this quickly. Please remember TDS has to be credit or payment, whichever is earlier. So each of these sections will tell you, like most sections are credit. So credited in your books is when the TDS has to be accounted for, deducted actually. The deduction should happen at the time when it is charged in your books. Only in case of salary, majorly, is the TDS to be deducted at the time of payment. Now, if the PAN is not provided, then the 206 AA provides for deduction of TDS at the rate of 20%. And there is a mechanism where returns will have to be filed once you get your PAN and you are able to then claim the TDS. So this is something that has to be seen. The condition relating to inoperative PAN is with effect from 1/6/2024 for individuals. The PAN Aadhaar linkage is mandatory. So if it is not there, then the PAN will be inoperative and 206 AA will apply and you will have to deduct at the rate of 20%. The PAN Aadhaar linkage, non-linkage will also mean that several other services other than TDS deduction will also not be available to that particular assessee. So it's important that we check the PAN Aadhaar linkage when making payment to individuals so that the right rate of tax TDS is applied. And that is a you can do it through bulk, or you can do it even individually just on the portal, on the main homepage of the portal. So whichever way, but you must ensure that the PAN Aadhaar linkage is there and then deduct the requisite rate of TDS. Otherwise, 20% will have to be applied. Now, as far as TDS challans are concerned, we were talking of the 281 challan, which is TAN-based challan. And when you have to deduct and deposit your own self-assessment advance, then it is challan 280 through your PAN. Now, the TDS by the 7th of the month, only in the case of March, it's deposited by the 30th of April. Deducted for Q4, nahi, deducted for March to be deposited by 30th April. You need to get a TAN for operating the TDS provisions. If you do not have, please get a TAN and operate. If there is late deduction or late deposit of TDS, then there is interest. Late deposit, late deduction 1%, late deposit 1.5% for the year, for the month or part of the month. Even if it's 1 month, 1 day, then it will be for the entire month. Then you can give the 16A forms quarterly also, annually also. Sometimes people just don't give because they they are able to see that in the 26 AS. So yeah, it's good to give it from the Traces portal, download and give it to the concerned people so that they can check that the TDS is correctly reflected in their 26 AS. These are the two TDS returns, 24Q and 26Q. 24Q is for salary. So these are generally the returns that we file in not for profits. Okay, so I'm explaining to you everything which is basically for you. I mean, if we start doing 26, 27Q and 27QB and 27EQ, all those, then it'll confuse you hugely. But what I say is that when you are working in an organization, then these are the two returns, quarterly returns that have to be filed. When you file these returns, which has the PAN number of the deductee, only then the TDS that you have deducted will be able to be passed on to the PAN of that person. Otherwise, how will you pass it? So it's in the through the TDS quarterly return is where you distribute the TDS to the concerned PAN of the deductee. इसलिए समझना जरूरी है कैसे प्रोसेस चलता है. For most of the quarters, it is the following month. April, May, June के अंदर July 31st, 31st October and 31st January. Only in the case of Jan to March, it is 31st of May, because for the month of March, the due date for deposit of TDS is 30th April. 31st May, you will deposit the TDS return, and that will get reflected in the 26 AS of the deductee somewhere around 7th or 10th or 15th, when you can download, and also by that time you can download their 1616A, or you can, or that deductee can see the 20 in the 26 AS by around 15th or 20th or maybe 30th, sometimes depending on how processing is happening on the portal. That's how the entire process gets completed. Now, if you do not file, or you do not correctly file your quarterly TDS return, there is, uh, both interest and penalty. If you are filing late, then there is a penalty. If you are filing or not filing, okay, penalties for incorrect information or provide or not for failure to furnish the returns, then there is a penalty. Now, those penalties can be 1 lakh rupees and cannot be waived up to 1 lakh rupees, minimum of rupees 10,000. So what I'm saying is that if you are complying with TDS, you have to also comply properly with quarterly TDS returns in terms of information, so that the credit of that TDS can be passed on to the person who is receiving, who will receive the tax credit. Now, I'm now moving on to some of the other sections which are important. This section says receipt of cash donation by not-for-profits. Now, the 269 ST is for businesses, but is also applicable for not-for-profits. If you are receiving donation in cash, so can you receive donation in cash? Yes, you can receive donation in cash. How much receive donation in cash? Not specified. But what is specified is that you cannot receive cash donation more than 2 lakhs from a person in a single day or in a single transaction. Okay. Till that, or in one event or in one occasion from a person. So up to 2 lakh rupees, if you receive by way of donation in a day from a person, that can be considered as cash donation. Will the person who's making that donation get ATG? Answer is no. But can you keep that 2 lakh rupees as cash and report? Yes, you can. Can you file Form 10BD? Yes, you can. The contravention of if you accept more than 2 lakhs is equal amount of penalty. This particular provision of 271 DA is also applicable to charitable trusts. Now I come to section 206 AB, which you must be knowing. 206 AB was specified person. Many of you did not even bother to find out whether somebody is specified person and higher tax rates has to be charged or not charged. And there was this compliance check functionality for 206 AB that was created. Now, I'm not getting into this, but what happens is up to 31st March 2025, this section said that if there is a person who has not filed the return for the previous year, immediately previous year within the timeline, and TCS TDS is more than 50,000, then and condition means both conditions have to be fulfilled, then the rate of tax TDS was different, not the normal rate, higher rate. However, and there was a compliance check functionality through the income tax portal, the department's portal, that was available for checking on bulk or individually whether this person is a specified person or not. So also the compliance portal helps you to see whether PAN Aadhaar linkage is there or not. Now, this particular section has been deleted from 1/4/2025. So this is no longer applicable. You do not have to do compliance check and you do not have to have differential rate of TDS from for payments made from 1/4/2025. A lot of organizations even didn't know about this provision. They have not even done compliance check to find that out. However, this is no longer applicable, but the inoperative PAN condition or the condition relating to PAN Aadhaar linkage is something that is non-negotiable. Now, moving on to 194Q, which is on TDS on purchase of goods. So if you are purchasing some goods, then the purchaser has to deduct some TDS and report in 26Q. This provision says that if your turnover, if your gross receipts or your from the business of the purchaser is more than 10 crores and the purchase from the that seller is more than 50 lakhs in a year, then the TDS on that amount of purchase, that is on the purchase of goods, not income, not services, will be deducted at the rate of 0.1%, non-PAN 5%. Okay. So if your turnover is more than 10 CR and you are purchasing goods in excess of 50 lakhs in a financial year from a buyer, from a seller as a buyer, then beyond 50 lakhs, you will have to deduct. So the government, what is doing is trying to widen the tax base to be able to capture such transactions of the seller so that the seller cannot then evade taxation by saying that he did not sell. So this is 194Q, but it is applicable to organizations which cross the threshold in terms of gross receipts and uh, who whose purchases from that respective seller is in excess of 50 lakhs. 206C1, I told you about TCS. So we have been doing all TDS provisions. Now, if you are dealing in non-timber farm produce, NTFP, then the seller will collect from the buyer tax on purchase value, okay, for telu leaves The seller will collect 5%. The timber under or other than a lease is 2.5%, or any other forest produce, it is 2.5%. Okay, so this is something that has to be seen. However, if it is used for processing, this condition will not apply. So when you are dealing with, there are 206C1, many other goods. But for us, if we are dealing in non-timber fiber farm produce, then these are the TCS provisions that are applicable. 194R is another contentious section. This section talks about perquisites or benefits given to service provider, a consultant like me. I don't get perquisites. Perquisites is mostly linked to employment, but benefits may be given to me by way of, for the service that I deliver. Then can I go to that per place? Can I stay somewhere? Can I, can my accommodation, can my travel, are some things which are considered as benefits to the service provider. In case of a contractual staff also, this can be extended, saying that this is a benefit for delivering the contract. So it depends on how you are interpreting. I am not getting into judgment on this, but I'm only saying it has different connotations. But what does the section, it does not apply to salary, but what does the section says? If you are giving any benefit to a service provider who has claimed that benefit by way of reimbursement, then if that amount is more than 20,000 in a financial year, then the TDS on that amount will be 10%. Just like you have TDS on the service provided by that person under 194J, if it is. Then similarly for the benefits that you have given. Now, the contention is what is the definition of benefit which has not been specified. But a more strict definition of benefit is that you are benefiting the person, you are giving a benefit to the person to deliver that service. So the way out here is, and that is what is clarified also, is that if these so-called benefits of travel or stay is made in the name of the organization and is not claimed as a reimbursement by the service provider, then it will not be falling under the definition of 194R. Okay, this provision has been applicable from 1st July 2022. Again, very contentious, but I still need to share it with you. The last section is what is called as 197. So when you earn income by way of interest or by way of dividends, majorly most organizations earn some income by way of interest. Okay, you may also earn income by way of professional services if it's a business incidental. In all those cases, there will be a TDS deducted from that income that comes to you. Now that you are a charitable organization, so you should not be taxed. What it also does is it reduces the availability of cash for you because you depend on this income only. You don't have any profits or any, you know, unrealized gains or anything like that, or realized gains really. So the department has said it's available to everybody, but but it's more applicable or more relevant to the not-for-profits. If your track record both on the e-portal as well as traces is clear and there is no demand, no proceedings, then you can file form number 13 specifying what is the income on which you would not want TDS to be applied. And that amount will not be deducted, or concessional rate may be deducted based on form 13. So the the this is with the traces portal, this is with income tax TDS, that you will have to file this form 13 online, and under 197 you will get a certificate with concessional or nil TDS. So suppose I have a 100 crore bank deposit, a fixed deposit with a bank on which I get 80% interest. On 8%, 10% will be deducted, which is what you can see is 80 lakh rupees. Now 80 lakh rupees I will get as refund 3 years, 5 years, sometimes under 245. Some demand will come, something will happen, and that refund will get adjusted based on 245. So what is the way out? If your track record is clear, You can save this 80 lakhs and improve your cash flow for that year. However, please remember this 197 benefit is only for one financial year at a time. And this form number 13 can also be filed as early as February for the next financial year, stating these are the incomes on which I will not want tax deducted. So that in first week of April, second week of April, you get that TDS deduction. The deductor will also be online given this 197 benefit ka detail saying that you will not deduct TDS on these incomes for this assessee, or you will deduct concessional rate of TDS as may be decided by the tax TDS authority. But this certificate is only for 1 year at a time, and it is a tedious process to get it. Even if you have all your track record on portal as well as traces in order, then also there is a lot of here and there that needs to be done to get this. But organizations which have significant amount of income on which TDS is deducted, say for instance, I told you 100 crores and 8 crores and 80 lakhs. 80 lakhs is not a small amount. So if you are dependent on 8 crores and 80 lakh goes, means your 10% of that income for that year goes, which you could have otherwise utilized. So that is one particular section which can be utilized by charitable organizations. I complete my session today, and now I am going to the chat. So Anil Jadhav is saying 2 lakhs can be shown as cash. Yes, it can be shown as cash because you have the mode of receipt option that you have to click. Okay. Then Romil says for Form 10 BDQ1, what if the donor details, including PAN, are not provided by the fundraising portal? If the unique identification number is not provided by the fundraising portal, that will be considered as anonymous donation. So with the fundraising portal, you must insist that if you are doing crowdfunding or whatever, and they now have that mechanism where they will be able to capture, because they know that if that information is not provided, you will not be able to report in 10PD. And while that may be through digital method, that may still fall under 115 BBC. What if the donor details are made available through fundraising portals, but the identification number is not available? So there are two things here. One is you need to have the identification number, whatever may be available, PAN, Aadhaar, passport, tax identification number, to be able to report on 10BD. If you do not have it, then you will not be able to fulfill that 10BD, because you cannot report 10 in 10BD without the unique identification number of the donor. You will not be able to do that. Now you might, that may not be anonymous donation. That detail you may have, that you have the name and address of that person which is available with the fundraising portal, and that you can contest in terms of anonymous or donation or otherwise known donation, but you will not be able to report it in 10BD. So our suggestion is, when you do fundraising portal, please make it clear that not only the name and address, but one identification proof should, or detail number, then we need the number, should also be captured by that portal, so that you are able to not only comply with 115 BBC but also comply with 10BD. Okay, so now I don't see any more questions. Can we take up any questions that you have, uh, where you can unmute and ask questions, please? We will do questions for another 5 to 10 minutes, 5 minutes, 7 minutes, because we are already 6 past 5. 5 more minutes, we can do questions. Okay, open for question. The house is open for any questions. Uh, I hope you have got the hang of it. With these two sessions, we are completing our income tax coverage for not-for-profits. If you know this much, I think you are very good to go as far as income tax for charitable organizations is concerned. Okay, you might be much better off than most people currently working for years and years in the not-for-profit space. For ATG receipt, threshold limit of cash donation is INR 2000. However, we can take cash donation You can take cash donation of any amount. It should not be more than 2 lakh per day per person. Okay, that is the one provision that I just want to uh, clarify. So for you, there is no problem because there is no, just like anonymous donation has a ceiling, for cash donation, there is no ceiling, only one ceiling, 2 lakh rupees, one person, one day. Other than that, you can take cash donation where the name and that's not anonymous, the name is known. You can report it in 10 BD as many number of times, no problem. However, the donor more than 2000 of cash will not get the donation benefit. So technically, why will a donor give you more than 2000 rupees cash when he cannot get the benefit? Now, people might want to give more than 2000 cash and not take the 10 ATG benefit. Then there are other reasons for that, which I'm not going to get into. Under which limb animal welfare is covered? So, in my understanding, there can be animal welfare if it is part of wildlife, okay, then it can be preservation of environment. That's how you have to look at, because it says forests, watershed and wildlife. Now animal welfare, if it is not wildlife but it is more tamed animals, then you might have to look at GPU. So these are two options that are available. I don't think there is anything else. We can file revised return. Yes, you can. As many times as you want to. 10BD. So can we get ITB 2025 soft copy, Shiva Prakash? Just type income tax bill 2025. There is a PDF that will pop up. That is your ITB 2025. It's the whole document. I will suggest you please see chapter 17B more specifically because that is what affects you. Can we file 10BD before expiry? Yes, you can. The last date is 31st May, but you can file before that. And the data for 10BE will be available maybe next day or in a day or two. You can always file. The due date for filing is 31st May. You can even file before 31st March. But there's no point in doing that because then you will be filing and filing. So our suggestion is that you file in the month of end April or May, whenever your 10BD Part B is completely ready, you can file it, no problem. But the last date is 31st May. Now we can file Form 10BD for no 23, 24 10BD form you will not be able to file. You can revise a filed return. Any more questions? Lakpanu Welfare Society is from Nagaland. Okay. And I can see Lakpanu Welfare being here. I'm so happy these people are joining. Um, they are from Nagaland. They have no access to what happens in the not for profit. And I'm so happy that these people are joining. Mariam, if you are there, please unmute and say what did you understand today? Okay. Can I receive a consolidated check online transfer from multiple donors? You can, and you can bifurcate and report in 10BD. This is permitted. Now, if the details of so the first part of the question is, Romil, that multiple donors means you collected say a lakh of rupees from company Y, company X, and the donation goes to the respective individuals, okay, employees. It's possible to bifurcate and give the benefit. The issue is that 15 donated, but details of 5 are not available and 2 did not have identification code. Now, in that case, what can happen is that 15, the ones who donated 15, you bifurcate. The rest of the amount, uh, you will not be able to provide those details. You will not be able to file 10BD. Else, what you can do is you can file 10BD for the organization for these 5 people or 7 people because their identification uh, numbers are not there. Details of 5 are not available means if the identification number, I don't know what the details are, the identification number and whatever needs to go in part B have to be there. If it is not available for these 7 people, you may file the amount uh, for on behalf of that company who's collected it. So it's possible that the ATG benefit goes to them. Details means names and address available, as good as not having the unique identification number. Is it required to reconcile form? So why was 10BD introduced? One, it was to eliminate bogus ATG purchase receipts that were issued, and this entire, you know, mafia of ATG people working for ATG in the month of March. That was one. The second thing what government wanted to do through 10BD was to ask the organizations to self-report on what donations they have received. Now, what does it mean? It means that in due course of time, this is your income. So when it comes to voluntary contribution, what is voluntary contribution income that you will show in your ITR? Corpus, donations, specific grant. You will capture all that. Kinds grants also you will capture. But kind grant will be received as kind, okay, and applied as kind. All right, that we leave aside. But then the 10BD data and the total income data might not match. But the 10BD data will give you the total income which has come through banking channels mainly. And the rest of the amount will be treated as anonymous donation. And if it is more than 5% or 1 lakh, whichever is higher, the department can just impose that 30% tax. You understand what I'm saying? That's the reason. Uh, 10BD filing, yes, 10BD filing is meant. So today today somebody writes back to me saying that the foreign donor will not claim 10BD 10BE ATG benefit. Imagine. So the 10BD responsibility is your responsibility, not the donor's responsibility, is something you must understand. Foreign contribution that has come has also to be reported. Please get the tax identification number of that entity or the passport number of that foreigner, whatever it is, and please capture it in 10BD. So that is why it is very important that you should capture the donation at the point when it is received in terms of the table which is given in 10BD Part B. So make an Excel sheet as per Part B of 10BD, and whenever you get that donation, please update that sheet so that after 31st March, you can file that 10BD anytime without having to run around. All right, I am now closing this session. Okay. Next Friday, we are going to do the CSR law. Our organizations depend on CSR funding, and increasingly CSR funding will be the mainstay for not-for-profits. The CSR law applies to corporates. Please remember that. Why am I doing the CSR law for NGOs? Because the CSR fund is being used by you. Unless you know what are the provisions in the law for CSR, you will never be able to satisfy the corporates in terms of compliances. So next week is going to be very interesting session on the CSR law, what it should mean to NGOs. There are 15 points or more or less there, and each point we will see and we will find that actual compliance of each of these 15 points is by default by the corporate, but actually by us. All right. I will encourage more of the organization staff to ask questions. And please, we will have a small session on PATIC, which is our knowledge repository that we have created about 15-20 minutes, either next session or the session after that. And I will like all of you to join PATIC. I have put you on the mailing list on PATIC. That's a huge resource which is free of cost. And wherever you are located, anywhere in the country or the world, you can have access to that. That is about statutory regulatory compliances for not-for-profits primarily. That's what it is. So we will have a small peep into that. We don't want to market that. but huge resource that we have. Thank you very much. Don't bother. I will satisfy you for all the 8 sessions. You please be with me with open mind and faithful concentration. I think nobody in this sector today at this stage in this country is providing this kind of simplified way of explaining the law to people who are working in not for profits. This is something that I can say, and therefore I want your 100% attention only for 2 hours in a week. Thank you very much. See you next Friday.